Hello everyone. I welcome you all to Tech Mahindra's Q4 FY'26 results press conference. Before we begin, I would like to inform you that there'll be a Q&A session at the end of the conference. Today we have with us on stage Tech Mahindra's CEO and Managing Director Mohit Joshi, joined by Chief Financial Officer Rohit Anand. Without any delay, over to you, Mohit.
Thank you, Abhilasha, and thank you all. Thank you for joining us here today as we report out the numbers for yet another great quarter. I just want to start by highlighting that FY'26 was a very important year from the perspective of our deal momentum. We closed the year with our highest ever deal wins in the last many years. Notably, we secured 2 mega deals over consecutive quarters aimed at accelerating innovation, strengthening digital resilience, and delivering AI-led operational efficiencies. One of these, you will all remember, is the large deal that we secured last quarter with the telecom client. This quarter, we entered into a global partnership with Orange Business. This 5-year collaboration is intended to accelerate end-to-end digital transformation for enterprises worldwide with a strong focus on AI, automation, secure digital platforms, cloud, cybersecurity, and scalable solutions. We have further enhanced our right to win by making our offerings increasingly AI-led. We have invested to embed AI across service lines, augment capabilities, and bring in seasoned industry specialists to drive innovation and execution at scale. Full year's revenues for Tech Mahindra stand at US $6.385 billion, up 1.9% on a reported basis and 0.6% in constant currency. During the year, our focus remained on disciplined execution, staying close to clients, and progressing our solution-led approach. Operating profit is $797 million, up 31.4% YOY, with margins expanding by about 290 basis points to 12.6%. Rohit will, of course, walk us through these numbers in more detail. Moving to our vertical performance for the year, we delivered growth of about 5.9% year-on-year in manufacturing. Growth in this vertical was led by aerospace and industrial process manufacturing, which helped us navigate a softer environment in US auto. The contribution also came from a ramp-up in European auto clients through our subsidiary. In BFSI, the vertical grew 3.7% year-on-year. Our focus on specific sub-segments like asset and wealth management, payment, and insurance platforms is yielding results. We are receiving an increasing number of analyst recognitions, with the latest being TechM's position as a leader and star performer in 2025 banking and payments by the Everest Group. Our approach in strengthening leadership coverage, investing in pertinent capabilities, and winning engagements with Forbes 2000 accounts has helped improve momentum across priority markets within BFSI. Within communications, we grew 2.6% year-on-year. This was led by stabilization and increased spend from our largest US client. Comviva also grew double-digit, adding momentum. In Europe, we saw improved stability through the year. We are focusing on ramping up deal wins as we enter FY'27, benefiting from scope expansion and deeper client relationships. In retail, travel, transportation, and logistics, we grew 7.3% year-on-year. This was our highest growing vertical within the financial year. The growth was supported by a focus on key accounts, coupled with strong tailwinds in the logistics domain, driven by e-commerce expansion, automation, and warehousing and last-mile delivery optimization. TechM was awarded the retailer's favorite, underscoring the trust placed in TechM's reliable and outcome-driven transformation services at the National Retail Federation's VIP Awards. The high-tech vertical declined 2.7% year-on-year. We faced headwinds in the first half of the year, including restructuring at a semiconductor client and muted discretionary spend. In the second half, we began to see signs of stabilization across clients. We continue to watch spending across high-tech clients with continued investments in data centers, influencing their spending patterns, and we are making our efforts to partner with these clients to refine and tailor our services to their evolving spending priorities. In healthcare, revenues declined by 0.6% year-on-year. We continue to see regulatory policy-related challenges across provider and life sciences segments, resulting in muted discretionary spending. At the same time, we are seeing increased engagement with large payer clients around data and AI-led initiatives, creating a clear pathway to scale enterprise-wide adoption programs as as AI adoption accelerates. From a geography standpoint, Europe delivered a strong growth of 8.9% year-on-year, aided by currency tailwinds. Within Europe, we saw encouraging traction in aerospace, industrial manufacturing, and European auto. We are seeing an active pipeline of vendor consolidation opportunities. The Americas was broadly flat overall. While comms in the Americas grew, this growth was offset by softness in US auto. Turning to our client metrics, our $50 million plus clients increased by 4 year-on-year to 29, and our 20 million plus client base expanded by 7 on a year-on-year basis to 66. This growth reflects our continued success in deepening client relationships and expanding the scope of services delivered across the portfolio, including data, AI, and consulting-led engagements. Our market positioning and investments over the last year have been centered around AI delivered right, and this posture is paying off in our client engagement metrics. Coming now to our quarterly performance, we reported revenues of $1.625 billion, up 4.9% year-on-year and 2.4% in constant currency. Manufacturing vertical grew 11.8% year-on-year, followed by high-tech and retail at 6.6% year-on-year and 6.2% year-on-year respectively. Communications grew 5.6% year-on-year, followed by healthcare at 4.7% year-on-year. During the quarter, we participated in the India National AI Mission. Our participation was structured around 3 strategic pillars: Indus and sovereign AI platforms, ecosystem partnerships, and stack orchestration, and applied AI across manufacturing, agriculture, education, and inclusion. We also launched an education large language model in partnership with NVIDIA with the intent of democratizing education. We are also advancing in our progress as an AI-first organization. We launched our enterprise-wide Cloud Code training program, a strategic upskilling initiative designed to strengthen our AI engineering capabilities at scale. We are enabling our associates across 3 strategic AI engineering platforms, Cloud Code, Devon, and Cursor, to accelerate adoption, build enterprise-scale expertise, and meet evolving client expectations. We also announced a collaboration with University College London to advance joint research and solution development in Gen AI and quantum computing. We will cover our AI strategy in more detail and progress during my presentation after the results update. The financial year also saw an improvement in the deal wins ratio. We closed the year with total deal wins of $3.794 billion, representing a 42% growth year-on-year. Tech Mahindra is increasingly positioned as a strategic partner to clients rather than only as an outsourcing vendor. Let me share some examples of our notable deal wins this quarter. A leading North American automotive OEM selected us as a strategic partner for application development and support across mission-critical enterprise systems. A Fortune 500 energy major chose us as the sole strategic partner to run and manage infrastructure, cloud, service desk, end-user computing, and allied services, while driving measurable efficiency across the technology estate. We were also selected by a leading global public health alliance for a managed services engagement focusing on sustaining high service quality and operational agility while enabling continuous digital innovation to drive efficiency and mission-aligned transformation. Alongside these client wins, we continue to deepen our partnerships and alliances across the ecosystem. With Microsoft, we launched an ontology-driven agentic AI platform that accelerates telecom and enterprise data modernization. Built on Microsoft Fabric and Azure AI Foundry, this solution is designed to enable explainable, auditable, and real-time AI-powered decision-making while supporting secure and governed deployment of AI agents. With NVIDIA, we partnered to introduce an industry-first AI-powered telco network operations reasoning agent. The solution is intended to help communication service providers accelerate towards level 4 and higher autonomous networks by evolving traditional network operation centers into intelligent closed-loop operations. With FICO, we partnered to help BFSI organizations accelerate value creation through AI-powered decisioning and advanced analytics. This partnership will help deliver end-to-end consulting implementation and managed services, enabling enterprises to fully realize the capabilities of the FICO platform and realize faster, measurable business outcomes. Tech Mahindra was recognized in the S&P Global Sustainability Yearbook 2026, achieving a top 1% ranking in the IT services industry, reinforcing our commitment to building a resilient and sustainable enterprise. Also reflecting our sustained brand positioning and strengthening, we advanced to the 4th position among the India headquartered IT services firms and 9th globally in Brand Finance's IT Services 25 report. As we step into FY'27, we will continue to build on the progress we made over the past 2 years. While the global backdrop can still be demanding and geopolitical volatility existing, we are encouraged by the way we have strengthened our client offerings, built added trust, and deepened our client engagement approaches over the last 2 years. With that, I'll hand it over to Rohit for the details on our financial performance.
Thank you, Mohit. Good evening, everyone. This year, as you know, has been marked with many uncertainties, such as tariffs, wars, coinciding with the second year of our transformation journey, which we started last year. However, we closed the year knowing that we stayed focused on what we could control. Let me just walk you through the quarter and the full year financial in detail, starting with Q4 performance. Revenue, we ended at $1625 million compared to 1610 million in the previous quarter. On a reported basis, revenues grew by 0.9% and 4.9% on a YOY basis. In constant currency terms, revenue grew 0.6% QOQ and 2.4% on a YOY basis. Within that, BFSI led the growth for the quarter, up 8% QOQ. High-tech's up 2.5% QOQ, and communication supported by Comviva seasonality is up 1.8% QOQ. Manufacturing is flattish, but up 11.8% on a YOY basis. In rupee terms, revenue stands at 15,076 crores, up 4.7% QOQ and up 12.6% on a YOY basis, aided by favorable currency movements during the quarter. The deal wins for the quarter stands at $1073 million, up 35% YOY, and reflects a continued deal momentum. As Mohit mentioned earlier, we closed FY'26 with the highest ever deal wins in the last many years, underlining our client confidence in Tech Mahindra's transformation capabilities and our solution-led go-to-market approach. Operating profit for the quarter is at $223 million, up 5.5% QOQ, and margin improves by 70 basis points to 13.8%. Project Fortius, FX tailwinds, and Comviva seasonality contribute positively, while we continue to invest in AI and work through transition cost in our large deal. In rupee terms, our operating profit is at 2,084 crores, up 48% YOY, aided by favorable currency movements. As of March ending, our hedge book stands at 0.75 billion versus 1.05 billion in the prior quarter. Compared to March 25, the hedge book is lower by 62% from $1.96 billion. This is in line with the change we made in our hedging policy, where we reduced the hedge tenure from 2 years to 1 year. The effective tax rate for the quarter is 24.3%, and on a full year basis, the effective tax rate is close to 27%. For FY'27, our normalized effective tax rate should be in a similar range. Profit after tax for the quarter is at $145 million, up 15.6% QOQ and 6.7% on a YOY basis. In INR terms, PAT was rupees 1,354 crores, and our PAT margin stood at 9%. Coming to full year performance, revenues ended up at $6,385 million, up 1.9% on a year-on-year basis and 0.6% on a constant currency basis. Within that, retail, as Mohit mentioned, travel and logistics led the year's growth, up 7.3% YOY, while manufacturing and BFSI is up 5.9% and 3.7% respectively. Comms was up 2.6%, with Comviva delivering double-digit growth. Healthcare was flattish YOY, while high-tech declined by 2.7%. Full year operating profit for the year is at $797 million, up 31% on a YOY basis, and as margin expanded 290 basis points to 12.6% for the full year. In rupee terms, EBIT is at 7,152 crores, up 39.2% YOY. Our day sales outstanding was at 89 days, which is broadly in line with the previous quarter. We remain focused on disciplined working capital management and continued emphasis on receiving our receivables and improve cash conversion over time. Free cash flow for the year is at $616 million, which is 115% of our reported PAT. Cash and cash equivalent for the company stood at $892 million. In line with our stated capital allocation policy, the board has recommended a final dividend of rupees 36 per share, taking the total dividend announcement for the year to 51 rupee per share. This is the highest ever dividend we've announced. The full year dividend payout ratio works out to be 104% of PAT and 91% of free cash flow. Thank you. With that, Abhilasha, with Q&A.
Thank you, Mohit and Rohit. We will now conclude this stream. For those of you who've joined us on social media, thank you once again for joining us. We will now open the conference for a quick Q&A session for media friends who've joined us here as well as virtually. For those who are online,